Hello, today I would like to talk to you about the logic between the direct and the indirect methods of statement of cash flow. And I kind of come from a little bit of a funny perspective. So what did I come up with to explain it to you? So here you are. You've got a wonderful 3-year-old niece, and maybe you're having a family reunion. So you packed up your backpack and you threw in the only box of sugar cookies that you have, a mix. And you're all excited. You will be a good uncle to your niece. What happens? She's not so excited. Very sorry about that. Why? Because she absolutely loves peanut butter and she actually wants peanut butter cookies. Forget about your sugar. So what are you going to do? Well, the only way to survive this adventure will be to take the sugar cookie mix and transform it into peanut butter cookies. How would you do that? You're going to compare the recipe and ingredient mixture included to what you actually pulled up on your phone to see what you need for the peanut butter cookies. So you're going to go line by line comparing the two, and you only will add or subtract what the difference is between the two. For example, you can clearly see right off the bat you need 1.5 cups of peanut butter because that is not included in the sugar cookie mix. So what will it look like? Just like we have it on the income statement. The minute you picked up net income, all of the ingredients listed on the income statement is included in this box, or all of these, whether you want them or not. So you will have to go carefully through every single ingredient and adjust it for what you need or what you don't need. So in this case, you will need right away, you remember, you have to add back depreciation, amortization, or depletion expenses. Very similar to peanut butter. Why? Because those are non-cash items. We don't pay them in cash, but they're included in your sugar cookie mix in the net income as your depreciation expense. So they're subtracted. We want to neutralize them by adding them back. What else would you do right away before you forget? So that's your first step. Second step will be you will deduct gains and you will add back losses. Why is that? Both gains and losses are presented on the income statement. However, they're part of a larger part of cash proceeds on sales, and those are part of your investing section. So will be in the next section. Otherwise, you're going to double up on your gains and you're going to double up on your losses. So again, we're going to neutralize those as well. And then your third part will be you will be deducting debit changes. I'm going to put triangle for change. Or you're going to add credit change in your current assets and current liabilities. So don't touch anything long term, but take a look at the changes in your current assets and current liabilities. And I presented more about the indirect method in 2 extra videos that I taped a long time ago. But I wanted to explain the logic. Why is all this funny with subtracting debit changes and adding back credit changes? Well, it's very, very similar to what are we doing here. No wonder the indirect method is called the reconciliation method, because we're reconciling 2 recipes. We've got a mixture of net income with everything included. Some of it we need, some of it we don't need, and we need to only look at the differences to be able to have a nicely baked peanut butter cookies. And a word about the direct method that is usually discussed in the upper level accounting classes. I call it cooking from scratch. Why is that? Because there are specific items that you need for the direct method. You're not starting with net income or the mixture. you're starting from scratch. So I can pick the ingredients that I need for my peanut butter cookies out of what I have. And I can grab, if I need butter, I can take butter, but I'm not going to take oil. So for example, I will not be picking up gains and losses because I don't need them. I know they're part of the next section, so I'm not touching them now. And I will grab some eggs and etc. A word of caution with regard to depreciation, amortization, and depletion again, because sometimes those non-cash items that I don't need could be not separated on the income statement, but rather included as part of the operating expense. So once you're picking up operating expenses as your ingredient, you accidentally will also be including those, and you don't want them. So if it says operating expenses 90,000 including 5,000 worth of depreciation expense, you will not be using 90, but you rather do 90 minus 5 of depreciation. You will start with 85. I kind of put it as a funny looking peanut butter because I want the peanut butter, I want the operating expenses, but I don't want the chocolate with it. I don't want depreciation, amortization, or depletion. And sometimes the only way you will know if you have amortization or not, if you take a look if there were any changes in your intangible assets, for example, patents, because typically we will not have maybe those even amortization expenses listed. So that's about it. Here's a quick explanation how is the direct method preparation and the indirect method different.